Hey, before we get into the show, I just want to remind you guys that I do a newsletter every Monday. It's a sales tip straight to your inbox. It's called Sales Ammo. You can sign up for free to receive these emails by going to artofsba.com, and we'll put you on the email list. And then you can start getting these golden sales nuggets every single Monday to start your week. All right, now let's get on with the intro. Lumos gets brought up on just about every episode these days because they are changing the way SBA loans are underwritten, especially small loans. So I wanted to take a second to explain the power of Lumos. So here's how it works. Lumos' scoring model, Prime Plus, leverages over 1 billion data points to come up with a predicted expected loss. So now you can quickly and efficiently decision each new loan request. Guys, we're talking about auto decisioning on small loans up to $500,000. They'll even sit down with you to build out a customized credit profile that matches the risk tolerance of your specific institution. Lumos is defining the next chapter of SBA lending, and it couldn't be coming at a better time with the rise of the small loan program. By the way, you can use Lumos to score your existing portfolio too, so that you can see where the weak spots are before there's a problem, and that way you know where to focus your resources. Let Lumos take your small business lending to the next level with cutting-edge analytics by going to lumosdata.com and scheduling your demo today. Hello, and thank you for tuning into the Art of SBA Lending. I'm your host, Ray Drew. The topic of the day, the SBA 7A Small Loan Program. For years, SBA has been making a concerted effort to generate more small dollar loans. And for years, lenders didn't want to because they weren't profitable to do. But that all changed in 2023 with the new SOP, which increased the size of an SBA small loan to $500,000 from $350,000 and removed a lot of the red tape. For the first time in recent years, the average loan amount went down in fiscal year 2023 compared to the previous year. And that was during a period of inflation, by the way. There's a ton of different factors at play here causing this renaissance of small loans, and we're going to break it down. Let's start with the obvious one. Follow the money. Somewhere around 2022, something weird started happening with the secondary market. Large loans began trading at less of a premium compared to smaller loans. And the shops that were doing a bunch of small loans, batching them up and selling them, were getting crazy high premiums. We're talking close to 15% premiums compared to, at the time, like 9-10% for an average 10-year loan. And even less than that on the larger 10-year loans. So certainly that changes the ROI calculations for the banks selling the paper. This was also around the time the economy started to turn and conventional lending options began drying up. The big banks, to my surprise, stepped up and started cranking out these small loans. The big banks like US Bank, TD, Chase, Bank of America, and Wells Fargo, they started leveraging their branch networks to process these loans. If you look at the numbers so far this year, all of their average loans are under $500,000, and they've done about 10,000 units of 7A loans through the first 9 months of this fiscal year. That's 5 banks doing 20% of the overall units. And of course, their motivations are totally different. They aren't selling their paper. You also have the fee waivers on these small loans going back years now. I don't really think that's moving the needle much. It's more of just like icing on the cake for these small business owners. Now let's talk about a big driver, technology. Prior to 2020, it was still pretty commonplace for SBA shops to be operating using good old-fashioned Microsoft Office and not an actual LOS. Once COVID hit, it forced the SBA industry into the 21st century. At the time, we had rising wages and shops were looking at ways to gain efficiency. It was a perfect storm. Then finally, you had the changes to the SOP, which make it easier to underwrite and close these smaller loans. So all of a sudden, banks are paying way more to operate their large loan program, and the premiums are being discounted there. And then over here on the small loan side, you have higher premiums and a less expensive way to operate. All of a sudden, that nerd that no one wanted to talk to is now the belle of the ball, and everyone's trying to figure out how to prop up a sustainable small loan program. Sustainable being the key word, because it's not all good news. With the small loans and the looser underwriting comes more risk and more defaults. So I asked the question, how does a bank that isn't Wells Fargo create and scale a serious small loan program? Let's break it down into 3 areas. Originations, how do you find these smaller loans out there in the market? Underwriting, how do you assess credits without doing what we would call a full underwrite and still maintain relatively low defaults, and processing. How do you create a quick and efficient closing process that protects your guarantee? Let's start with originations. The folks looking for $50,000 to $150,000 are not the same clients who are buying businesses for $3, $4, $5 million. Sure, your existing BDO team can refer some of those businesses, but that won't scale. The current method that most high-producing shops who are selling their paper use is partnering with what I'll call mega brokers and lender marketplaces that deal in volume. These brokers have a ton of deal flow. Only problem is they want to be paid handsomely for it. I will warn you, don't be short-sighted and ultra-focused on the short term. The goal should be to originate organic leads by utilizing the same marketing tactics that these mega brokers are using. Now let's talk about credit. This is the part that no bank has figured out just yet, but whoever does is going to win, and they're going to win big. Now we know loans up to $150,000 have the 85% guarantee, so there's less risk there. But what if we can auto decision $300,000, $400,000, and $500,000 loans and create similar or perhaps even better outcomes than if we were to fully underwrite those loans? The SBSS score ain't doing that. We don't even know what's in it. Lumos's Prime Plus scoring model is the closest thing we have to that. The question is, do we still need to do a cash flow analysis? If a bank can figure out a way to auto decision loans without spiking their default rates, and I think it's possible, they're going to win this next chapter in SBA lending. Finally, you have to close the loans. You need to become Rocket Mortgage for small SBA loans. It's going to take a bank that has the discipline to follow the SOP to the T, but not require all those extras that they feel are necessary because they got dinged on an audit 2 SOPs ago. We're in a different world now with a different SOP. This is what SBA wants. So with that, it's game time. With us today, we have President and CEO of Windsor Advantage, Mike Breckheimer. Joining us from Colony Bank, we have the President of SBA Lending, Darren Davis. And last but not least, we have President of SBA Lending and co-host of the BDO show, Christopher Hackney, with us today. Welcome, everyone. I'm going to go to you first, Chris, with this, because you guys do a ton of small balance loans. Given the secondary market and everything I mentioned, are you guys doubling down on these small loans right now?
Absolutely. We, as you mentioned, we've had success in the secondary market. Our bank was founded on small balance lending. We were doing it before it was the sexy thing to do. Back in 2016 and 17, we partnered with some fintech companies. So it's always been our business model. Just thankfully, what's caught up are the premiums have increased for those smaller dollar loans. So we are continuing to increase our small balance production. However, we are interested in diversifying and looking at some larger loans as well to couple these small balance loans that we do, because we could talk about this later. Although the SBA says they want small dollar lenders, behind the scenes, you do get a knock on your door that says, hey, you can't do all small dollar lending. We need you to do some larger loans as well. So it's kind of inverted the approach for us a little bit.
Darren, you launched your small loan program and it seems to be taking off. How impactful are the small loans going to be on your SBA program going forward?
Yeah, we're kind of managing this right now. We're definitely newer than Chris and Bay First at this. So we kind of capped at where we want to be as far as dollar volume for a little while till what you said in your monologue. We kind of figure out where the defaults are going to be. We're trying to be mindful of, SBA integrity is a big part of what we're looking at too. So right now, it's going into this year, we thought it'd be about 50-50. It's probably a little bit more at the beginning of the year. I think it's going to even out. The second half of the year, we're going to end up at that 50-50 mark. But really, it's an ongoing process of evaluating the outcomes of the loans, how they're performing, and so forth. And we're really taking a little bit babyier steps than just going all in at the very beginning. Gotcha.
Perfect. I'm going to go to Mike with this now, because you guys have this Excel program that allows banks to do small loans without having to increase their overhead. You guys are an LSP. Have you seen a shift in banks wanting to get into this small loan stuff?
Yeah, Ray, we have. I mean, our Excel program, which exactly is what you said, it's essentially kind of a fintech-based LOS, fully digital processing system that allows banks, like a Colony, to spin up similar, infrastructures that say a Bay First, now has and dominates, kind of on a variable cost basis. And over the last, roughly 24 months, we've seen that demand more than triple. Now, that being said, on the small loan side, probably about 10 to 20% of our origination that we see across our entire platform here at Windsor is through that small loan program. But we're seeing more and more demand. I think we've signed up, roughly 10 institutions just this year that have really come to us and said, hey, we see this as a trend. We see the average dollar demand going down, and we know we need to solve for it because, as we all know, it takes just as long on the old standard way of doing things to close a $2.5 million loan as it does a $250,000 loan. So I think it's probably the way of the future, to your point. And I think it's a combination of the technology as well as the administration changes that are kind of offering those incentives for both borrowers and banks to really step into the program.
Yeah, no, it's definitely a shift going on. And, that's why episode 2 of this Town Square series is on this program, because it's just the change is happening right there, but we get so bogged down in our day to day that maybe some people miss the opportunity, but we're putting it out there. Now, I want to shift to the origination side. Darren, you guys really are taking off in the rankings. You're at the top of the list. And I'm just curious, how are you sourcing this deal flow? Are you guys partnering with the fintech warlords?
Yeah, I wouldn't say the fintechs, but it's a broker network that we have. We started off with going direct is what we tried at first, and the results were not very good at all. Using lender match, other services, it was not only difficult, low approval rates, but also getting the deals through the system too were very difficult. So we actually did a whole just shift in how we're going to originate from a direct model to a broker model, originally with a system that didn't handle brokers to test it out. So that was kind of a tough change for us, but that really made a big difference as far as getting actually solid deals in and getting them through the process as well too.
Okay. Well, I know, Chris, you partner with a lot of the fintechs, right? Like you said. So when it comes to like partnering with them, what are the keys to success? Especially for the high volume brokers, like what are they looking for in a partner?
From the fintechs, consistency of the program. Initially, when we focused on our 150 product, the Bolt loan, BOLT, when we instituted that, it's what's the saying? You're building the airplane while you're in the air. We didn't really know, okay, how do we manage credit risk? So we would have one set of parameters. And within 3 to 6 months, we would change that and say, oh, we need a FICO of this, and this is a new guardrail and a new guardrail. And fintechs don't like that because they like their business model is to go out and, acquire customers, and they know what fits and pre-qualify those customers and place them with the right bank. So when you change it too often, that disrupts their sales process. Yeah, to answer your question, in partnering with fintechs is just having that open line of communication. What we've done really is built out a liaison as their primary role is working with fintechs on a weekly, monthly basis of reporting on our side of, hey, your conversion rate is this, your default rate is this, we're seeing industry trends in this, we're seeing your turn times are in this range where other partners are in this range. So that's someone's full-time role where they're in charge of fintech and some larger broker partner relationships and managing those and monitoring SLAs, conversion rates, and things of that nature, where I'm sure a lot of SBA shops don't have someone who's full-time managing just broker relationships and fintech partnerships and not really sourcing the volume, but just managing the volume that comes in.
Yeah, it's a different model.
Right.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, well, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show.
It's interesting, though, that, I think in the same level, in our clients that are stepping into this for the first time are actually utilizing kind of a lot of those same metrics, but beginning to embrace it now and are going organic. And though they're building successful SBA shops, in their realm, though, I mean, nobody's stepping up probably against the Colonies and the Bay Firsts at the current moment. But when tracking SLAs and utilizing that kind of standard credit box or credit matrix and approach, it's key even for small lenders, credit unions, and CDFIs. I mean, we've got some groups that are organically sourcing through Lender Match and just their kind of standard centers of influence channels, upwards of 10 to 20 million a year through this program. But in the end, if you waver to Chris's point from those credit parameters and you start to change, your DSCR requirements, your FICO requirements, and those other areas, you're going to blow up your model. So the key is, you mentioned it earlier, Ray, is what is perceived risk versus actual risk? Make sure you get your team to commit to that up front, your executive and credit committee to commit to that up front, and then just really, you got to lean into it. So we've seen that successful as well, just on the organic side.
Yeah, I would add to, just as far as a holistic look at the kind of parameters, it needs to be a pass-fail model. You can't have, hey, let me just look at this. I mean, there's exceptions that happen that might make sense, but if it fails, and you got to move on to the next one. Just to have the consistency across the board. And that was a big mind shift too, getting used to that as well.
Well, and if you're rolling it out and you are dealing with some of the bigger brokers, I mean, it's a pilot program at first, right? And if you communicate it as such of like, hey, we want to partner with you on this, but just know things are going to change as we kind of figure out what's what as we build this product, but you guys are going to be a part of that. So getting their buy-in upfront to kind of prepare for those changes, Chris, like you said, I think is helpful in managing those expectations.
Exactly. It's like any sales. You got to set the expectations properly upfront.
Right. And some of our early missteps were we would have kind of a knee-jerk reaction with the parameter and change it just because we had a couple, a batch of loans that didn't perform. And we would tell our referral partners, hey, this is changing in 2 weeks. And, they don't receive that well. So just making sure you're working on those changes or notifying your partners in real time and giving them adequate time to change their sales process and their flow if you're really partnered with these fintechs and brokers. And one thing I would say too, if I had my rathers, organic is what we're trying to figure out at Bay First, and I'm sure we all are. Fintech partners and the broker partners are not doing it for free. And if they're giving you a lot of volume, they charge a pretty penny, which eats into the premium. And as we all know, over a certain threshold, I think it's 110, or if memory serves me correct, you split that with the SBA. So you have that. And then if you have a referral partner who's taking a nice chunk out of the premium that's left, it doesn't become as profitable as it should from top line. Then you kind of come back to the larger loans, there's equivalent premium there. So I think we're all kind of in a race of how do we figure out organic originations in the small balance. That's who really will win this battle in the small loan space.
Absolutely.
I think utilizing some of the SBA tools like a Lender Match can be successful to a point. We've seen a couple shops that dedicate a couple BDOs, young, hungry business development analysts learning the program for the first time, kind of going through Lender Match, be successful in the realm of $5 to $15 million of annual production. Right now, I mean, look at Colony's numbers and Bay First numbers. Success is a relative term, so I think it's finding that combination of being able to add both. There's only so much volume that's just going to organically show up to you, even if it is through something like an SBA, tool like Lender Match. But you've got to find that combo.
I was going to say, I'm sure Chris tried Lender Match too as well, but that's what we started off with. It was very tough.
Yeah.
They've obviously made changes since then, so I can't speak to what it is today. I can only speak to what it was, 2 years, a year and a half ago or so, 2 years. But the clientele coming through there, we had a tough time for them even knowing their tax ID numbers, to be honest with you. So we couldn't even get the right information in to start the process. So
Well, isn't that the nature of a $50,000 loan? You're dealing with, I don't want to say less sophisticated, but like just a type of buyer who doesn't have a team of, they definitely don't have a CFO. They not even have a bookkeeper. I mean, they're just starting out and they're operating a much smaller business.
You definitely do. I mean, part of it was a system we had. It was pretty locked down. So once you enter in the information, it was hard to change. So that was just what we realized as well. I mean, going in, we thought people would know some basic information from their tax return, telling them pull your tax return up, but it's more difficult than you would think.
Yeah, and what we did too, you have to look at some of the language you include in your application. Maybe they don't understand a certain term that we understand as SBA lenders and make it more common language. So we looked at our application and we have the little asterisk where you can hang your cursor over and explain a question that's being asked in detail too. And I don't know the exact number, but I would venture to say a lot of these borrowers in the small loan space, particularly 150 and under, are solo entrepreneurs, someone that's selling a widget online. They don't have, more than 2 employees or maybe just themselves. They don't have the time to, upload a bunch of documentation. You have to eliminate the friction in the small loan space too, or else they would go to the alternative lender that can give them, $100,000 of capital in 24 hours at a 50% interest rate or whatever it may be. Their main concern is how quickly can I get the capital and obtain the loan that I need rather than what's the rate. So we found it's important to reduce the friction and the speed at which an applicant can apply for the loan and get into the queue.
Mm-hmm. And I hate to say this because I think everybody wishes there was, that silver bullet in technology, but clearly all 3 of us are on what I believe is probably a very sophisticated version of some sort of LOS that has just given us a massive amount of efficiencies and dramatically improved our, entrepreneur and borrower experiences over the last 24 to 36 months. But to Chris's point, at least what Windsor has found, and again, a lot of our origination from our partners are organic, you still need a body on the phone. So you still need somebody to hustle and set expectations at the lender. And then Windsor's got our equivalent of a relationship manager that is helping, coach them through that to kind of almost get through that Rocket Mortgage style process. So I still think we're, at least in our world, at the point that it's less bodies and less human touch, but that telephone call is still necessary to close that loan in 7 days.
I want to shift to the credit side of things, Mike. I want to spend a lot of time here. How do you take a 40-page credit memo and condense it for scalability, but not take on too much risk?
Yeah. That's a great question. So most of our lenders that are typically developing their small loan program start out with a credit matrix. So this is not an algorithmic, completely data-driven model that no human touches. Again, this is a combination of both. So it's looking at your credit score and your FICO, combining that with where you see a high level debt service coverage, combining that with SBSS and a couple other character attributes such as years in business versus startup. What we have seen success with most of our lenders is they, again, kind of going back to Darren and Chris's point, spend a large amount of time setting up a scoring parameter, right? And you can do it on an Excel platform or something, and then you categorize your loans. And so as those come through your pre-qual, you pretty quickly know whether this is a green light, yellow light, or red light. And so being able to kind of set that up front knocks out a ton of kind of the additional narrative and background and marketplace commentary that you find in these old school commercial credit memos. And then remember, most of these loans are simpler structures. So you've got less about affiliation background. You typically don't have a massive amount of owners that you have to do a ton of global on. And so when assessing some basics on spreads and some basics on the 5 C's of credit, we have felt that you can condense what typically is a 25 to 40 page robust commercial C&I memo to a good 8-page efficient memo that knocks every single thing the SBA needs and knocks the main strengths and weaknesses that a credit committee needs to quickly approve that loan.
Okay. So that to me sounds like standard light, like, which is definitely progress. But Darren, do you think we can get to a point where we're auto decisioning $500,000 loan requests?
I'm hopeful, but I don't think we're there right now. That was the vision initially when we got into this, but there still needs to be someone checking things. I mean, for data integrity, that's one big thing. Matching up. For instance, I mean, we look at personal financial statement and what they put on there versus what's on the credit report. Until we get to the ability to scan, OCR that, I think it'll be difficult. I also think we focus more on the working capital up to 150, and it's a different model than having to go after business acquisition, other types of use of proceeds. Going after working capital where we're starting off at really eliminates a lot of the kind of underwriting and other kind of SBA eligibility you have to work with, and streamlines a little bit more. Business acquisition, you got to look at different things. Debt refinance, you got to look at different things. So I think it also depends on the use of proceeds you're going to offer to how much you can condense that credit memo down.
Right. Well, I remember when Funding Circle, when they were coming out, they were putting out like press releases about like closing loans in 3 days, which is, I'm sure they were, in close contact with the SBA. So I think to myself, was SBA, are they envisioning us getting to a fintechy auto decision type of world for these SBA small loans, not just the 150, but even up to 500,000? Or are we just kind of like chasing waterfalls here?
No, I don't think they really want auto decision. They want it fast and accessible for underserved and small business owners. But I don't think they want for me to say, yeah, we're clicking a button and approving a loan in 3 hours and it closes the next day. What our approach here was, we focus on 150 and under primarily as well, and it's really based on use of proceeds and what Darren just mentioned too. I'm not comfortable doing a business acquisition on any sort of truncated analysis, but working capital perhaps, because we look at time in business. There's other guardrails, FICO, number of late pays. We're always improving our parameters and trying to remove ourselves. E-Tran is great, but you can't run a small balance program alone on E-Tran alone. And I think a lot of entrants into the small dollar space, if they're not working with Mike and his team, they make the mistake of, okay, I've got an E-Tran of this and a FICO of this. I'm good to go. This is my small dollar loan program. The more you can enhance and add to that, the safer your loan is. So what we're doing right now, and what people don't know too, like I talk to Darren often, I talk to other small balance lenders, and we talk about what our guardrails are. Not saying that we're all going to collude and have the same parameters. That's not going to happen. But just so we're checking ourselves, does this make sense? How do you approach this? So we're looking at net profit margin kind of thresholds, the number of UCCs filed in the last 12 months. If you're going out and you have to borrow 4 or 5 times in 12 months, you should be making money from your business to support your operations. That's a sign of distress in your business. So should that be a guardrail? We're also looking at bank statement. What I would envision, we're not there yet, is we can underwrite to bank statement cash flow. And then we're also partnered with a company called Loomis. I think Ray actually found them through the Art of SBA Lending podcast. We are not yet there where we are making decisions based on their score, but we do include their score in every small dollar loan we make. And then they score our portfolio after the loan is closed on a monthly basis. And we look at the score. And if the score is outside of our range, then we do an accelerated annual review and we keep a watch on those loans. And it's actually highly predictive. That it's not a plug. I don't have any investment in that company, but
they're the sponsor of today's podcast.
Well, that makes that makes perfect sense.
Yeah, we're onboarding them right now. So
yeah, so looking at, and what Loomis does, they look at factors beyond what we would take the time or worth the time for us to spend in grabbing that data. They're looking at unemployment statistics. They're looking at, all different types of statistics in the local geographical region, which if we were to do that as an underwriter, it's going to take an underwriting process for a $100,000 loan from 1 hour to 4 or 5 hours for a $100,000 loan to pull all this data and put it into the memo. We can just press a button from Loomis, get all that data, slap it in the memo, and there it is there. So my main point I'm trying to drive home is we're in the space that a lot of small balance lenders should be moving towards. What can we do beyond E-Tran from a credit risk standpoint? E-Tran is not enough to run a small balance loan program on successfully in a safe manner. It's a great factor to include, of course. I would never say that. Thank you, SBA, for providing that for us. But you've got to enhance your credit profile beyond that.
You're talking about the SBSS score.
SBSS scores, yeah.
Yeah.
And I'll go on Chris. I mean, the two parameters he talked about, the SBSS and the credit score, that's our pre-qualification pass.
Yeah.
So that kind of gets you in the door. And then we go
Right.
down a list of things similar to what Chris is doing too as well. Trying to judge character, you're trying to get an idea that can they pay it back reasonably. So those are just getting in the door, not a final decision.
Right.
So.
Yeah, I would echo that. I think any successful SBA shop that has a strong performance rating, right? And I would argue strong is, anywhere between, less than 1% to 2% of an overall default rate after a while, right? We're not advocating, I don't think anyone here that this will ever be a scratch and dent product. That you have to do more than currently what's provided. It would be wonderful if that predictive analytics was there. But there are so many times where we see an SBSS score out what I would consider a pretty strong level, right? Like a 190 plus, 200 plus. And then you run the cash flow, you actually look at the tax returns and it won't cash flow. I mean, and so SBA SOP would say, go for it, do that loan. And then unfortunately, we're tagging that guarantee. And so we see that quite often. You brought up the SBSS earlier, right? It'd be great to have it. And there's nothing against it. We use it on every single pre-qual and every single underwriting to help our lenders figure out that red, yellow, green. But again, it comes with that detailed conversation and that detailed analysis of the financial statements, bank statements, tax returns at the current moment, even if it's a small loan.
Well, I want to take a step back here, Mike. What's the biggest obstacle SBA shops are facing as we head into this next chapter? Do you think it's managing credit risk? Do you think it's the ever-growing marketplace demands, sourcing deals in a landscape that's becoming more competitive, something else? What do you think?
Yeah, I think, from the origination side, origination is hard, right? One of the reasons we are all continuing to partner with outside sources, and by we, I mean representing our lenders who continue to partner with brokers and marketplace shops and everyone, is that marketing is expensive. Marketing takes time to be able to understand where to organically target and where to spend your dollars in hopes of a return. And so I think the ever-growing space of the digital lender and the non-bank lender and private credit solutions that are offering, frankly, 7A replacement products is going to be an area where community banks, credit unions, and CDFIs are going to continue to have to compete. I don't think private credit's going anywhere. I think it's growing. And I think they're utilizing technology and a lower level of regulation to be able to target the same borrowers we would like to help distribute money to Main Street. I mean, as Chris alluded to, I think time and time again, we see strong borrowers that can't wait 14 days to receive funds, 7 days to receive funds, or they're just impatient because they've been sold the ability to get $100,000 tomorrow. Now, that might be a debt refi opportunity down the line, but that's not what we want to see, right? We'd like to be able to streamline this process going forward, and it's just not there yet. And then I think with respect to do what you do, the administration has done a great job and the SBA has done a great job streamlining this small loan process, but it's still very new, right? It went into implementation less than 12 months ago. And so the data behind do what you do for small loans and some of the shops that I believe might be out there, I don't know, I've never spoken to a shop that's accepted this on our end here with our client base, but some of the shops that might just be using SBSS, I don't think have had enough time to be tested. And so to your point earlier, I think it's up in the air whether we can trust that, do what you do down the line will be able to be implemented in a future administration. I think time will tell, which is why most of our clients are continuing to use, I'm going to use the word prudent, a more prudent approach to do what you do. So I think they're cutting certain areas of red tape to make it a little faster. But Ray, it's not that we don't trust what's going to happen in the future. I think everyone agrees that this was a massive shift and it's an unknown and it's been less than a year. So we need to be a little conservative on how we approach this product to see how everything pans out from a performance level.
Well, we're going to begin wrapping it up here. Chris, I was looking at the numbers the other day, and I was curious, why have you only gotten 2,500 SBA approvals in the first 9 months of this fiscal year? Why not 5,000? What's holding you back? No, but seriously, is it the deal flow?
Weeks off.
What is the biggest challenge of scaling that though? Is it the deal flow, the finding quality deals, getting them closed?
Yeah, it's deal flow. We in particular have put a pause on certain industries at the time, for concentration, other because of risk. And those industries are one of the more common industries that you would receive loans from. So we noticed, we knew it would happen, but we noticed a quick, I think it was a 17% drop the month after, and it's kind of stabilized now. So that's probably the impediment for us is just the industry that we're precluded from financing right now, which will probably open up later on there. Also keeping us from scaling, just finding new partners when you have so many people entering into the small balance space, right? If it's just Chris, Mike, and Darren, then there's 7 fintechs, we'll say, or 6 fintechs, we can split them evenly. But if it's Chris, Mike, Darren, Jack, John, Jill, then those fintechs, they separate their volume or bifurcated, and half goes to Darren, half goes to Chris. And so that kind of dilutes the pre-quals that come your way too, which is fine. There's enough volume to go around for all of us, but you will see an impact if you are at the top and doing it before everyone else and more entrants are coming into market. You're going to notice a slight decrease as more players enter into the market as well. So that's another impediment for us scaling. I think, honestly, I'm comfortable with where we're at. I don't think we want to be above. We do 25 to 30 million a month in small balance loans, 200 to 250. To me, I think the risk associated with doing $40 to $50 million a month in unsecured $150,000 loans, I'd lose some sleep at night doing that much and that scale. So we're kind of fine with where we're at. We can always, I hope Tom doesn't watch this episode because he wouldn't like hearing that necessarily. But there's risk to consider as well as far as scale when you're talking about an unsecured loan, even with an 85% guarantee, and also with SBA not paying guarantee fees into the kitty. They're not. I think they didn't anticipate such a massive shift and swing into small dollar lending. And with the fee waivers, I think we're going to see a shift back to maybe a small guarantee fee being included in small dollar lending as well, which that's not going to stop any borrower from obtaining an SBA working capital loan. That's not going to be a deterrent at all. But I do think we'll see a shift back to that. Well, our focus right now is just really how can we get more organic volume in without a broker or fintech partner.
Yep. And we're going to end it on a lovely note here, Darren. What about all the small business success stories? Because when you're closing more units, that means we're touching more business owners. Is there anything to say there?
I mean, definitely. I mean, I hate going back to PPP and mention that in our industry anymore, but I mean, you are helping out the small business. This dollar means a lot to them, right? So, I mean, that's the rewarding part is hearing, thank you. This is going to make me go to the next level, whatever it is. But there's some great stories we've heard from our borrowers, what this money has meant to them.
Awesome. Well, that concludes our show today. I want to thank our SBA contributors. Thank you for watching. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The Video Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.